Warren Buffett's annual letter is definitely something to look forward to. This letter is full of advice and provides a glimpse into Buffett's thoughts on the stock market and the overall investment landscape. Surprisingly, Buffett continues to hold cash rather than invest in stocks. Many investors are concerned because if the greatest investor of all time cannot find appealing investments in this market, it must imply that the stock market is overvalued. In this video, we'll go over the key takeaways from Buffett's letter, including why Buffett continues to sell more stocks than he buys right now. Before we begin, please do hit the like button and subscribe to our channel for more content like this. Now let's read the letter. One of the things that investors have been paying close attention to is Berkshire Hathaway's growing pile of cash. The cash on Berkshire's balance sheet has been increasing over the last 10 years, but it has reached an all-time high in the last few years, rising from around $100 billion in September 2018 to a mind-boggling $144 billion at the end of 2021. When you hear these stats, you might think to yourself, isn't it a good thing that Berkshire and Buffett have so much money? Yes and no. I'll explain. So the good news is that Berkshire Hathaway's operations are extremely healthy and generating a ton of cash, which is fantastic. On the other hand, the bad news is that that huge cash pile means Warren hasn't been able to find any appealing investments to make. Buffett mentions that Berkshire Hathaway must keep at least $30 billion in cash on hand at all times. Consider this as a safety net, just in case the company's operations begin to falter. So if we begin to subtract $30 billion from the $144 billion of cash Buffett possesses, we can conclude that Buffett possesses $114 billion more in cash than the company requires to operate. To put that amount of money into perspective, it's enough to buy the entire companies of Goldman Sachs, BlackRock, IBM, and Starbucks at current market prices. Now, I'm not saying Buffett should buy any of these companies, but it does put Buffett's wealth into perspective. Now, I'd like to draw your attention to one line in that letter that I believe is the most important sentence in the entire letter. Berkshire's current position is the result of my inability to find entire companies or stocks that meet our long-term holding criteria. Now, why is this line so crucial? This is Buffett's way of saying the stock market is overvalued without actually saying it. Buffett has never been one to be vocal about his market views throughout his career. He's never been one to give interviews in which he screams about how the market is overpriced and that a crash is just around the corner. Instead, he has taken a much more subtle approach. Buffett recognized that the market was overvalued, and it turned out that he was correct. The Nasdaq, an index of technology companies, peaked at around 5,000 in March of 2000. By the end of 2002, the bubble had burst. The Nasdaq reached 1,200, and it did not recover to its March 2000 levels until 2015. The Nasdaq was so overvalued at its peak that it took 15 years to return to its pre-dot-com bubble level. Now, there are various valuation metrics that investors use to determine whether the stock market is overvalued or undervalued. The price-to-earnings ratio, or P.E. ratio, is one of the most commonly used metrics. For short, all else being equal, this is calculated by taking a stock's price and dividing it by its annual earnings. The higher that number, the more overvalued the stock, and the lower that number, the more undervalued the stock. The S&P 500, which includes the 500 largest companies in the United States and is widely used as a proxy for the stock market, is currently at nearly 24 times. According to research, the average P.E. ratio of the S&P 500 over the last 90 years has been around 15 times. On this metric, the stock market appears overvalued, but what if we look at the stock market using a method Buffett devised? The Buffett indicator is a cleverly named indicator whose math is simple. It's the total value of all publicly traded companies divided by GDP. GDP is essentially a measure of a country's economic size. So this means the Buffett indicator is simply calculating the value of all stocks in a country divided by the size of that country's economy. This method, according to Buffett, is the single best indicator of where valuations stand at any given time. The current market capitalization of all publicly traded companies is approximately $46.2 trillion. The US GDP is currently estimated to be $24.1 trillion. So doing the math yields 1.92, and converting that number to a percentage yields 192%. The famous Buffett indicator is currently at 192, raising the trillion-dollar question, how does that compare to history? Well, the answer isn't all that great. Unfortunately, the historical trend line since 1950 indicates that a score of 120 represents a fairly valued stock market. The current Buffett indicator score of 192 would seem to suggest that the stock market is significantly overvalued based on historicals. So even though Buffett has been implying that the stock market is overvalued, there has been one stock that he spent billions of dollars buying over the past 2 years. $51.7 billion to be exact. And that stock isn't Apple, Bank of America, or his iconic Coca-Cola holding. Over the last 2 years, Buffett's favorite stock to buy has been his own. That's right, Buffett has been repurchasing Berkshire stock worth tens of billions of dollars. This demonstrates how crazy the market is right now, as the world's greatest investor can't seem to find anything to invest in other than repurchasing Berkshire stock. Here's what Buffett had to say about this, but before that, do hit that like button and subscribe to our channel if you like our content. Returning to what Buffett said, he stated, "Our final path to value creation is to repurchase Berkshire shares. And shares are increased with that simple act. Repurchases have made sense for Berkshire Hathaway's owners over the last 2 years. As a result, we repurchased 9% of the shares that were outstanding at year-end 2019 for a total cost of $51.7 billion, he said. That expenditure resulted in our continuing shareholders owning roughly 10% more of all Berkshire businesses. Whether these are wholly owned as in BNSF and Geico, or partly owned as in Coca-Cola and Moody's, the best way to think about share repurchases and why they can be so powerful is to imagine a house owned by 5 people. Assume that the house is worth $500,000 in the open market. If the house is sold on the open market, it could fetch this much. This means that each owner's share of the house is worth $100,000, which can be calculated by taking the $100,000 value of the house and dividing it by the 5 owners. Let's say one of the owners wants to sell their interest in the house because they need the money quickly to make a different investment. And rather than going through the process of selling the house on the market, this person is willing to be bought out for $80,000. This means that each of the 4 remaining owners will have to pay $20,000 to buy out the owner who wants to sell for $20,000 lower, and when you multiply this by 4, this comes to $80,000. Now that one of the owners has been bought out, there are only 4 remaining owners of the house. That's still worth $500,000 in today's money. This means that each of the 4 remaining owners' shares in the house is worth a total of $125,000. This is $25,000 more than what each year was worth before they bought out the 5th owner. So each of the owners spent $20,000 to get $25,000 in additional value for each of their shares of ownership of the house and property. As a result of purchasing the previous partner who wanted to sell, each of the owners' net worth increased by $5,000. This logic also applies to share repurchases, assuming they are made below the true value of the business. This is what Buffett meant when he said he used share repurchases to increase the wealth of Berkshire Hathaway's remaining shareholders. Here's another way to consider the impact of share repurchases. This is why share repurchases can be so effective if done correctly, which is a big if. For Berkshire repurchases to make sense, their shares must be reasonably priced. People don't want to overpay for other companies' shares, and overpaying for Berkshire would be detrimental to its value. And that just about brings us to the end of our video. If you enjoyed our content, please do hit that like button and subscribe to our channel to see more content like this. We'll see you in the next video.